Good afternoon. Let's just possibly try to give it a few minutes for those who may still join us. Let's try to give them just a few minutes. Maybe they're still coming. In the meantime, please complete the attendance register. All right, just a few minutes. We will just start now. For those that just joined, I'm just going to quickly share the attendance register. All right, a very good evening. Please complete the attendance register for today so that we can quickly start. If you can just quickly complete the attendance register for me. We will start now. Just wanting to make sure that we all complete the attendance register. All right, then let us just quickly start. I will start us on a few questions. This is the last class today. So I intend just covering a certain work, and then the rest of the work we will try to do a Q&A with the left minutes. I had received a particular request to particularly do inventories. So that's the first thing that we will try and work out. It is the inventories. So I'm quickly uploading a question that we will do. We will focus mainly on the questions for this one, and not necessarily cover everything up. Due to trying to cover everything, we will therefore try to push into at least trying to cover some areas so that we can be able to have time to cover everything. But I've just shared the question quickly for you to be able to download it on your site. It's also available on the main site. I am quickly going to share my screen as well. All right, this is the question. Some of you may feel this is the question that we have done before, but please to note, the essence of trying to do this is trying to also assist those who are really struggling on this chapter of inventory. So it's a question on Stock Limited, who is a manufacturing entity. The following information for the year ended 31 December 2020 is available. You've got the revenue and other expenses. You are told what does inventory consist of. You are given additional information. Then you are told that use the above information to prepare the annual financial statements for the year ended 31 December 2020. Your answer should include the statement of profit or loss and other comprehensive income and the relevant notes. Your answer should comply with IFRS. The accounting policy is not required. So please take time to read this question on your side. I will, in the meantime, try to put the relevant headings for us to be able to work together on this question. So please read the question in the meantime so that we can do the question together. Can someone just quickly unmute for me, just to indicate that they are done reading the questions, or please make the relevant notes for us to proceed. Once you have done reading this question, please either unmute yourself or just quickly type a note for me. Lovely. So we've got more than one done. So here's the information that we've been provided. We are told that this is a manufacturing entity. So by manufacturing entity, we know that there is a process in terms of conversion of raw materials into finished goods, which therefore means that we are going to deal with manufacturing, where we deal with raw materials up until goods are ready for use. And all administrative and selling things would be, so in terms of what we have here, we are told what inventory consists of. Additional information, it's about raw materials. Work in progress and fixed overheads are located at 50 Rand per unit and is based on normal capacity of 2,000. So this means at this point, in order to understand what we are doing, we can already start here by saying we have revenue of 756,250, and then we have cost of sales, and now we are stuck on cost of sales because we can see raw materials purchases, we can see fixed production overheads, but one thing that we cannot determine is what is overall the inventory purchases. So that's what now we need to go and determine. At this point, we can also see administrative expenses. So after this, we'll have gross profit. So we can see administrative expenses, and then we can see other expenses. So administrative expenses, we can already put administrative expenses, we can already put 206, 250. And then other expenses, we'll come back to that and see if we have any other expenses. This is how far we can get. And then we cannot get much from there. So very important now, what we need to determine now is the cost of sales. So which means that we need to go now do calculation in terms of cost of sales. Now for us to do calculation in terms of cost of sales, we'll have now to follow the process of conversion from raw materials, opening, closing, up until we get to finished goods. So in other words, we will move to calculations. Under calculations, we'll say, one, we have to work with inventories in order to be able to calculate cost of sales. So we have different classes In terms of inventory, we have raw materials, we have work in progress, and we have finished goods. Let's just make sure. Raw materials, and then we have packaging materials, which in IFRS we call consumables. So that is your packaging material. This does not go through the tough process of conversion. Right, all these will be represented by values. So in terms of the movement, we'll have opening balance. Either we'll first have purchases, or in the case of transfers from raw materials to work in progress, from work in progress to finished goods, we may add any other costs. In terms of bringing the inventory to its location and position, we may take out sales or transfers, and then we will work with a closing balance. So all we are interested is to know this closing balance. So in terms of what we've been given, let us quickly look. We've got opening inventory in terms of raw materials at 96,250. We've got purchases, which are given there as 247,500. And then we are told that we also had transport in terms of raw materials of 700. And then the next thing that we look at is the closing balance. Now, this is where it gets tough. Closing balance, we are given two values. We are given 41,250. And we are also given 39,875. Now, in terms of international accounting standard, raw materials, work in progress, held for use in the production of inventories. So the key word is that it must be held for use in the production of inventories, are not written down below the cost if the finished product in which they will be included or incorporated are expected to be sold at or above costs. Repeat again, the raw materials used, that is raw materials and work in progress, held for use in the production of inventories is not, or are not, so the work in progress and the raw materials are not written down below cost if the final finished goods is expected to be sold at cost or above cost. So in terms of information that we've been provided, we do not hear any statement that tells us that they are going to be selling below cost, which therefore means that they are assumed to be making a profit because they'll be selling above cost. Therefore, we are going to use cost and not write down to net realizable value. So at this point, what we do here, we take all the costs that are above, and then we deduct your closing balance, and then we get your transfers. So I just want to get my signs right. So our value, therefore, of transfers into work in progress, therefore, becomes 303,200. So remember, this is not what is asked yet in this question. What you've been asked is to do the financial statements. So we move on and we check work in progress. Work in progress opening balance is 41,250. Do we have any additions? Additions are going to be transfers into work in progress from raw materials. Any other cost, not likely, but there can be conversion cost, but there is nothing mentioned at this point. And then we look at the closing. So similar reason that I've provided for not writing raw materials also applies to work in progress. So we've got here the closing balance. So what we therefore look at in terms of other costs is what are the costs that have been used. So it's other costs that have been used, which we call them conversion costs. Remember, we only had raw materials. Now we must get conversion costs. So where do we get these costs? It will be variable overhead cost and fixed overhead cost. So let us quickly look at how and where we get these. So we look at the information provided. There we see variable production overhead cost of 138. So it's variable production costs. So variable is 138,190. And then for fixed cost, fixed production overhead costs, it's 114,125. Can someone confirm for me if the fixed production overhead cost to use in work in progress is, do you use the cost as provided to you, the actual cost, or do you look at additional information number 3, where you allocate the fixed production overhead at normal capacity?
We use the normal capacity.
100%. So we never use the actual cost when we are dealing with work in progress. We use the normal capacity, which we've been given as 50 Rand multiplied by 2,000. So we've been given this as allocating 50 Rand per unit based on the normal capacity of 200. So this is 50 Rand multiplied by 2,000 units. Therefore, this means that your other costs will therefore equal 238,190. And then we will have transfers to finished goods. At 512, 515. In terms of finished goods, we have an opening balance of 110,000. We have transfers in as 512, 515. Any other cost in terms of fixed, in terms of finished goods, no other costs. We look at the closing balance of fixed cost. We've got finished goods, we've got net realizable value, and then we've got the closing inventory. So it's obvious here we are going to look at lower of cost, which is 56,375. And therefore we say the difference here is sales. Which is 566,140,000. And then we've got packaging materials, which had the opening balance of 4,800. And the closing balance being 4,400. This therefore means we've got sales of 400 that have occurred on consumables. Now, the other thing that you must still do in terms of consumables, it is application of a write down. So if we're looking at consumables, you've got a closing inventory of 4,400, and then you've got a net realizable of 3,985. So you have a write down in terms of consumables that you have to take into account. So you take lower of cost, or NRV. In this case, we've got cost as 4,400. We've got net realizable value as, let me just hide that, 3,085. And then you've got a difference of 415. This represents a write down to net realizable value. So where are we going to use this amount? We're going to use it on calculation of cost of sales. What else are we going to be using in terms of calculate cost of sales? It's going to be sales in terms of finished goods. So one of the other things that now we need to calculate is on number 2, it is cost of sales. So cost of sales is made up of finished goods, $566,140,000, 140 rands. And one other element in terms of cost of sales is the fixed production overhead cost. So remember, we had an actual cost of 125,000. And then we had normal capacity at 100,000. And then we therefore said that the difference between the two, which amounts to 114,145. Is therefore, is it under or over recovery? Is it under or over recovery?
Under recovery.
It's under recovery because we had expected our actual cost was 114 and we had a normal capacity of 100,000. We therefore need to push up the cost because we have under recovered in terms of production. So it's under recovery. And then we've got consumables that were written down to net realizable value. That therefore means that we've got a cost of sales value of 566,140 plus 14 plus 415 gives you 580,680. Therefore means you've got 580,680 in terms of your cost of sales. Very important. This is calculation number 2. Very important that you reference your work in order to be able to earn marks. And then in terms of our gross profit, we've got 175,570. Our other expenses now are therefore going to be 7,560. And then we're going to add the 400 in terms of consumables between opening balance and closing balance, which therefore means that we're going to have 760 plus 400, and then we get 7,960. Therefore, we move over and we say if we were required to disclose assets, we would say current assets, and then we would say inventories. And in terms of inventories, we would say this is in terms of note, let's say note 3, which therefore means that we need to go and make something that looks like a note. So on calculations, we can also do something that looks like a note in terms of inventories. So we're going to have raw materials, work in progress, and then we're going to have finished goods. And then we're going to have consumables. So all these we're just going to take here at the top. Raw materials, 41,250. Work in progress. And we have finished goods. And then we have our consumables. Sorry, our consumables is going to be 3,985 because we would have actually written off at the closing balance. This therefore means that this is our calculation where we got 171,735. Now, very important, we're asked to also do the notes. For inventory, we've already done the note here. So one can just quickly copy this. Just excuse me. Right, there we go. There we go. We've got our inventory reference to the calculation. And in this case, a note 3. Then in terms of profit before tax, what we are always looking for a statement that says profit before tax includes the following item. Let's say items in this case, and we're dealing with expenses. So we've got consumable written down to net. Please also note that when it comes to the face, when it comes to the face of the statement of financial position or the notes, you no longer write in abbreviations, you write amounts in full. So please not forget that if you are required to disclose a note, you will have things such as depreciation. You will have written down, you will have fair value adjustment. And in terms of depreciation, please do recall that you have got different kinds of depreciation. So that was as quick as we could get to this question in terms of inventory. Any question on what we just covered now? Any question in terms of inventory? All right, let me just quickly share. Assignment 2. And this is due to the types of notes that were given by the lecturers. So I want us to quickly look at the notes. This was the lecturer's feedback. I just want to quickly go through the feedback before we actually do the assignment. So the first thing that the lecturers have raised is the following questions seems to have posed problems. Number 1, entity headings. It was found that you are not having a proper layout in terms of your headings, in terms of your name of the statement that you have been required to perform. And also the difference between statement of financial position, it says as at, and the statement of profit and loss says for the year ended. Statement of changes in equity says for the year ended. Notes say for the year ended. So it was one of the things that we highlighted to seem to be confusing for students. Very important in an exam, you will not have sufficient time. Therefore, it is important to only address what is required. So it was noted that students have a tendency of also answering what is not required. So please be careful of this in an exam. And then in terms of the PPE note, it is the calculation of depreciation. Please know that when you enter into an exam, you are there in order to be tested. You are there in order to test that you have grasped the accounting principles correctly. So you are not going to be given a depreciation calculation that is very obvious. There are pointers from when the information is given. You must read in terms of accumulated depreciation, and in terms of when you are given, let's say, vehicles. Are you given the cost? Are you given the carrying value? And in terms of the accumulated depreciation, is it at year end or is it an opening balance of accumulated depreciation? So those are things that you are supposed to know. The difference between depreciation capitalized and depreciation expense. Remember, depreciation capitalized will still be included in terms of the new asset, but on the main asset, where, for example, if you are using a plant to construct a building, the depreciation that you are going to allocate during the time you are using a plant, you are going to add it to the cost of the building. But when it comes to the plant itself, you are going to still indicate a negative depreciation, but under the line item, depreciation capitalized. Disposal is always a carrying amount, and you not use the selling price, but only the carrying amount. In terms of investment property, the whole disclosure was noted as something that is a challenge to students. The fair value adjustment calculation was also noted. So I'm going to request you just to spend some time reading on assignment 2. I'm just going to give you, let's say, 9 minutes. Yeah, I've just shared assignment 2 if you do not have it nearby. And then we will quickly start now on assignment 2. And we will not be covering the whole assignment. We will just cover the basics. All right, let's quickly cover this question. The required is to disclose the information in the statement of financial position of Dilata as at 30 June 2020 to comply with the requirements of IFRS and disclose only the note on PPE. We have been given the assets in terms of PPE. So I have quickly put down all these assets, classification of these assets: land, factory and office building, machinery and equipment, and motor vehicle. Now let's quickly look at land. So land, we are given a debit balance of 1 million, and we have to refer to note 1. Note 1 says, Dilata acquired and occupied the land on which both the factory and office buildings were erected on 1 July 2017 at an amount of 1 million. So this was at 1 July 2017. The land was revalued for the first time on 29 June 2020 by Mr. King. Let us quickly look. What is our year end? 30 June 2020. So it was revalued by Mr. King, an independent appraiser, at fair value of 1,500,000. So we have, you can just copy this as is and go and insert it here at the bottom. This is just like free marks. The land was revalued for the first time on 29 June 2020 by Mr. King, an independent zone appraiser, at a fair value amount. Very easy 2 marks that you are just earning for principles. In terms of that disclosure, we are told how much the amount was. The factory building was constructed on the land on 1 August 2017 and completed and available for use on 1 January 2018. The cost of the factory building amounted to 2,400,000. This therefore means that we have a land that was acquired. So in this case, we do not have a valuation. We have a cost, so you have a valuation of land if it was valued a year before it was bought. In this case, the price has remained the same of 1 million. There is no accumulated depreciation. Then you have got land land at 1 million. Let's quickly read if we'll have any additions. Here is about a factory building that was constructed on the land on 1 August 2017 and completed and available for use on 1 January. So there we've got cost of 2,400,000 at the beginning of the year. After expansion, so we've got an expansion, company withdrew, we've got motor vehicle. Then we are told that owner-occupied land is accounted for in accordance with the revaluation model. And the revaluation are made with sufficient regularity to ensure that carrying amount does not differ materially from the fair value at the year end. And then buildings, machinery and equipment and motor vehicles are accounted for in terms of the cost model. So nothing we will have on land. So we know that on the 30th, so we do not have additions. On the 30th, we are told that land was revalued at 1,500,000, which is therefore 1,500,000. We can also insert this calculation, which is 1,500,000 minus 1 million. and then there is no depreciation on land. Then the carrying amount is the sum so then the cost, in this case now it becomes the valuation and not only the cost, because now it's going to be 1,500,000. It's going to be 1,500,000. Right. Then we have factory and office building. It's between note 1 and 2. We've got note 1 as opening balance. Note 2, we are told that after the expansion of operation, an office building was built. The office building was completed and available for use on 1 December 2019. The following expenses were incurred in the building. In building the offices, labor cost 450 and materials 150. So you've got additions, which is 450 plus 150, and that is going to give you 600. And let's quickly look what else. Then the next one is the company withdrew its machinery and equipment from normal production for a period of 4 months during the current year from 1 July 2019 and used it in the construction of office building. No machinery or equipment were purchased or sold during the current financial year. So now we will need to calculate how much machinery and equipment depreciation that is equal to the 4 months. So we quickly have to jump now and look at the factory and buildings. We need to calculate the weighted depreciation in order to be able to move to machinery and equipment. So we are told for the factory and office buildings, it's 2% per annum. So we have now to look at the cost of 2,400,000 versus the period. So our year began in July 2019. The land was available for use on 1 January 2018. So we have to calculate how much accumulated depreciation that we have. So we were going to calculate the period. Factory. So what are we looking for? Accumulated depreciation. So we're looking for year 2019. So it's gonna be year 2018 and 2019. So in 2018, it's going to be 2,400,000 multiplied by 2%. And then if it was ready for use in January, we're going to say Jan 2018 to 30th June. So we've got 6 divided by 12, which gives us 240,000. $24,000. So there was something wrong there with my calculation. This is for Jan June 2018. And here we're going to have now a full year of saying 2,400,000 multiplied by 2% is 48,000. We add these together, we get 72,000. So this is therefore going to be this accumulated depreciation of 72,000. Then we are going to have 2,328,000. We've got additions. We can also only calculate depreciation once we are able to get all the necessary costs. So we have to first start with machinery and equipment. Unfortunately, machinery and equipment, we see a 3 million balance and we are referred to note 3. And machinery and equipment uses the 20% per annum. So we're going to have 3 million costs. And then we're going to say we're going to say machinery and equipment given accumulated depreciation. Please look at the date. This is an opening balance. This means opening balance, therefore equal to 1,920,000. It's a reducing balance method. So when we're calculating depreciation, we can calculate machinery and equipment, which is going to be $1,920,000 multiplied by 20%, reducing balance method. So reducing balance method is cost less accumulated depreciation. Therefore, we need to look at depreciation expense, and we need to get depreciation capitalized. So we are told this machine was used for 4 months. So this is going to be 4 months, and this is going to be 8 months. So this therefore means we're going to say 384 multiplied by 8 divided by 12. And then we're going to say 384 multiplied by 4 divided by 12 gives you 128. So we're going to illustrate this way. So you're going to have here depreciation expense of 256,000. And then you're going to have under depreciation capitalized 128,000, still as a minus, but please look how you are showing it. You are showing it as either capitalized or as an expense. This capitalization, you're bringing it this side where you are taking it and capitalizing it under factory and office buildings, 128,000. Now, what is important now, it is to calculate the depreciation. So let's quickly see if we can be able to calculate the depreciation. So in terms of factory building, we have an original cost of 2,400,000 that we can use. And then we've got also additions cost of 600 plus 128, which we can also use. So we know in terms of this one, this is just going to be 2%, which is 48,000. And in terms of this one, now we need to know, we are told that this was used from 1 July. We therefore need to say calculate 4 months from 1 July 2019. It's going to be July, August, September, October, which therefore means quickly want to look if we can find a date. Right, we are told here that the office building was completed and available for use on 1 December 2019. But if you are looking at this 4 months, this 4 months end in November 2019. So please look at that. That can actually be a biggest trick. So here it means July, August, September, October, 4 months until 31 October 2019. But now we are told in terms of depreciation, you only depreciate when an asset was available for use. So when was it available for use? On 1 December 2019. So it's going to be December up to June, which is 7 months. So we're going to have 128 multiplied by 2%, multiplied by 7 months divided by 12 gives you 1,000. I'm trying to think now what was here. Yeah. Multiplied by 2%, multiplied by 7 divided by 12 gives you 8,493. You add the 2, then you should get an amount of 56,493, which is an depreciation under your factory. Therefore, you've got 56,493. We do not have depreciation. We do not have disposals. Therefore, one thing that we have gathered is our cost was originally 2.4. We add the additions and then we add the depreciation capitalized, and it therefore became 3,128,000. And for accumulated depreciation, we're going to say accumulated depreciation plus depreciation, which is therefore accumulated depreciation plus depreciation, which is therefore 128,495. Machinery and equipment, we told that there is no additions, no disposals. Therefore, we can have here a cost of 3 million, and then we'll have accumulated depreciation plus depreciation. and also all the depreciation, including the one capitalized, we've got 1,464,000. In terms of motor vehicles, let's quickly look what we have under motor vehicles. We have 645,715. So we've got under cost 645,715. We've got under advocated depreciation 235,715. Which therefore means our carrying amount is therefore 410. Let's quickly look what's happening under note 4. On 1 January 2020, a motor vehicle with an original cost price of 205,715, on which 95,715 depreciation was already written off, on 1 July 2019 was traded in for a new vehicle costing 336,000. The motor vehicle was acquired for business purposes, but the transaction has not yet been recorded in the accounting records of Delata. So in terms of additions, we've got the replacement of 336,000. So what we need now to look at is how much did we dispose? So how do we calculate disposal? It's going to be cost less depreciation. So in this case, it's going to be 205,715 minus 95,715. All right, then we must still consider a little bit of depreciation. So let me quickly come here for motor vehicles, because we need to consider the depreciation for the current year. So in terms of motor vehicles, we look first at the depreciation policy is 20% per annum according to straight line method. Please note it's according to straight line method. Let us quickly get the replacement. So in terms of the replacement, we're going to say 336,000 multiplied by 20% straight line, and then we're going to multiply by the number of months. Who can tell me when was this new vehicle bought? Here is a date, 1 February 2020. So we're going to calculate from February, where we're going to say February up until June 2020, that's 5 months. Then we have 28,000, and then we're going to have old, and then we are going to have disposal. In fact, let's call it remaining. So remaining is going to be 645,215 minus 205,715. So we're going to have going to take the asset that we are disposing, 645,715 minus 205,715. And we say the remaining vehicle multiplied by 20% straight line. And this gives you 88,000. And then we're going to come to the disposal where we're going to say now 205,715 205,715, and then we're going to say multiply by 20% on cost, and then we're going to look at the period from 1 July 2019 up until 31 January 2020, and that is going to give you 7 months. July to that period is going to give you 7 months. And that therefore means that you're going to have a depreciation of 140,000. That is the depreciation that you're going to have, depreciation of 140,000. So here we have 140,000, but we're still looking at the disposal. So in terms of the disposal, what are we going to do? Remember, we're going to say cost 205 because we can only dispose of at carrying value. So we're going to say cost minus accumulated depreciation as given in the information. Then we're going to say minus 24,000, which is the depreciation of the current year. And then we're going to dispose the asset. And then we're going to dispose the asset at carrying value 95715. Sorry, my mistake here. So you're going to have 86,000. How you calculate the balance? It's going to be, remember, 400,000 plus 336, which is your additions. And when you are doing your accumulated depreciation, you're going to also take cognizance of what you needed to exclude. So this is 776. Because you have got to add the costs and the timing, therefore, of the costs as well. So the balance that we are looking for is this 6,507,000, which we have now to take here and come and put this amount here as 6,555,507. And this therefore means one would have been done with this question. So in terms of money in bank, which is the second question, I really do not want to be long on that question as well, but maybe we can only focus on investment property. So the key thing here is to be able to identify what is investment property and what is not investment property. So in this case, we've got 4 bullets. So we've got four sentences. Manenberg acquired land with an office building on 1 January 2022 for 3 million cash, land and buildings. Manenberg also paid agents commission of 45,000 and legal fees of 15,000. Move on. For the period from 1 January, Manenberg made improvements to the building amounting to 100,000. The subsequent expenditure meets the subsequent recognition criteria as contained in IAS 40. The land and buildings were available for use and rented out to the tenant on 31 March 2020. The tenant took occupation of the building on 1 April 2020. At year end, an independent zone appraiser revalued the land at 1,620,000 and the building at 3 million. Manenberg values investment property using fair value model. So you are asked to do a statement of financial position. And the note, so we're going to only focus on the note. So we know that the note is going to be land and it's going to be building, and then you're going to have a total which you intend to take to your statement of financial position. So here we've got carrying amount at the beginning of the year. We've got additions from acquisition. We've got additions from subsequent expenditure. That is things such as your improvement. We've got fair value adjustments. And then we've got carrying amount at the end of the year. So our year ends on 31 December 2020. And it would have started on the 1st of January 2020. Right. So at year end, we are told that we already have these balances. So I'm just going to quickly put my formulas. Right. So we are told that at year end, sorry, now I made a mistake. Year end, we already told that land was revalued at 1,620,000 and building was revalued at 3 million. So this is what we know so far. This is already what you can already take to your statement, the other statement. But let us quickly do the necessary additions. Improvements to building amounted to 100,000. So this becomes subsequent expenditure of 100,000. Acquisitions happened in the year that we are in, where we are told how much the building was, how much the land was. We have, so we do not have the carrying amount at the beginning of the year, that we do not have. So we seriously need to just quickly do calculations to work out the acquisition. So we're going to have additions from acquisition, which is going to be the purchase price. We've got purchase price all together. We've got 3 million. And then we've got agents commission, 45,000. And then we've got legal fees at 15,000. And then we've got the total cost of them together as 3,060,000. Now we need to have a cost for land and a cost for building. And the proportion that we are going to be using here, we're going to say 3 million multiplied by the original cost of 1 million on land divided by 3 million. Which is going to be 1,200,000. And then on land, we're going to say use the ratio of 2 million divided by 3 million in order to get the amount of 3,060,000. So here we've got land as 1,220,000, and then we've got building as 2,040,000. Therefore, it becomes easier now to say the valued amount minus the revalued amount minus the carrying amount becomes 600,000. And similarly here, 3 million minus 2 million plus 100,000. And then we have 860,000. So that is the value adjustment. The value adjustment, remember, if you do profit before tax, you have to include it as your other income, in this case, because our investment has increased. So that's basically it in terms of this question. And then in this case, we would go and say investment property. And take this value of 4,620,000 as is for your investment property. Right, there's a slide that I just want to quickly cover. So this is part of your non-current assets. Right, let us quickly cover other slides, then we can quickly take any questions that you can have. Right. I'm just going to cover these slides quickly. This is just as part of encouraging you for the last minutes that we have. For those that still do not know me, I am a qualified chartered accountant. In terms of the first learning unit of Introduction to Company Financial Statements, remember this can be used mainly in the multiple choice. So you have to have an understanding of shares in terms of the Companies Act, background from incorporation. You have to understand the different classification of shares: ordinary shares, preference shares, redeemable preference shares, non-redeemable. And then you have got to understand the preference shares in terms of where there is a cumulative effect and a non-cumulative effect. That is when the preference shares are not paid. Understand the difference between authorized shares is shares that are authorized at incorporation. They are in the memorandum of incorporation. And issue of shares, you are issuing shares. They cannot be more than authorized shares. Capitalization, rights issue, be able to do that calculation. Understand the underwriting policy in terms of underwriting of shares. Understand the dividends, different dividends between ordinary dividends and preference dividends and the calculation thereof. Dividends on the ordinary shares, you are always given an amount at the year end based on what the shareholders have decided in the AGM. You can also be given an interim dividend, which is normally cents multiplied by the number of shares. And the dividend is always fixed. It is a percentage multiplied by an amount. Learning Unit 2, it's a conceptual framework. It has got 8 chapters. This may be covered in terms of the theory as well, MCS. It covers the objective of the financial reporting, qualitative characteristics, financial statements and reporting entity, the element of financial statements, which is your income, expenses, assets, equity, and liabilities, recognition and derecognition principles, measurement, presentation, and disclosure, concepts of capital and capital maintenance. Presentation of annual financial statements, I honestly encourage you to always have the structure and the layout of the annual financial statement to understand and not to lose easy marks, to have proper headings and names to understand that the statement of financial position is as at. Ensure that the structure is close by during exams. Nice exam practice question. It's on comprehensive example 5. I recommend it any day. If you are able to cover it, please do make sure to cover it. Inventory, you have to understand, in fact, all assets. Your inventory, your property, plant and equipment, investment property, financial instruments. You have to make sure, including leases, you have to make sure that you understand the definition, measurement of inventory, cost of inventory. Remember, when you are adding cost of inventory, you have to bring all assets in terms of the pricing until the asset is in the location as intended by management. So you may have transport costs, insurance costs whilst the inventory is on transit. All those costs are included in inventory. Excluded costs are costs such as abnormal costs. You have to know the cost allocations, your first in, first out method, weighted average method. So all those methods you have to understand. Understand the principle of measurement of inventory that is measured subsequently at lower of cost and net realizable value. Recognition of an expense, that is a write down of inventory and the reversal thereof. You have to understand the two in terms of cost of sales and the disclosure of your profit before tax. Raw materials and work in progress write down principle. Always remember, if the finished good is not expected to sell at more than original cost, the raw material is not written down below their cost. But if finished product is expected to sell at less than cost, it should then be your raw materials and work in progress can be written down to net realizable value. Property, plant, and equipment, similarly. Why it is important to understand the definition? It is because of a strong classification with the investment property. Property, plant, and equipment is owner-occupied. Investment property is where we are holding a property for rental, or the plan is for rental. Similarly, in terms of costs, there are costs that are included and there are costs that are excluded. Please learn those in the prescribed textbook. Subsequent measurement, this is where, in terms of the cost model, we say cost less depreciation. You have to understand the policy to apply in terms of depreciation, whether it is straight line, whether it is diminishing balance method, in terms of the useful life of the asset. Depreciation expense and capitalized, we just covered it now. The revaluation in terms of land, because you can only revaluate non-depreciable assets such as land. You have to understand the disclosure note of PPE. Investment property, definition and measurement. Cost, understand the inclusion and exclusions. You may be also asked to apply value for money principles, such as the significant financing component as applied on revenue. Subsequent measurement, either apply the cost model or the fair value model. Understand the fair value adjustment when it goes under other expenses and when it goes under income. Be able to do the disclosure note. Leases, be able to identify whether there is a lease in a contract. Understand the short-term lease in terms of the recognition exemption. The straight lining of lease payments over the lease period. Be able to do the normal lease calculations where you can calculate the right of use of asset, the lease liability, and also in terms of the use of the financial calculator, be able to calculate the implicit rate if it is required. Understand how to do the disclosure note in terms of the finance lease and the lease liability. Financial instruments, besides definitions, classification of financial assets, financial liability. Understand the assets in terms of fair value through profit or loss, fair value through other comprehensive income, which one is not held for trading, which one is trading, speculative and short term. Subsequent measurement, changes to the market, classification of preference shares, very extremely important. Revenue from customers, be able to do the 5 steps revenue recognition, be able to identify a contract with the customer. There's also 5 steps in terms of identification of a contract with the customer. Identify the separate performance obligation in the contract, e.g., a car and a service plan. A car you receive now, but a service plan you will need it as after over a period of time. Phone, similarly, a cell phone contract, a phone you recognize immediately once rewards and risks are transferred, but data, airtime, SMS, and minutes are only enjoyed or you are obligated on looking at the performance in terms of recognition of revenue over time. Determining the transaction price, to look at variable consideration, discounts, discount, loyalty points, significant financing component, allocation of transaction price to the performance obligation. Performance obligation, that is in step 2. Be able to do any journals if required. Recognition of revenue when the performance obligation has been satisfied. So remember, at this point, we've been doing face-to-face schedule in terms of MS Teams. Notes per class have been put in on our Western Cape region. There's recordings available. All questions now, you can ask them to lecturers. There's a e-tutor support facility, which is there to support you 24/7. Not necessarily 24/7, but at least must respond to questions within 48 hours. Please make use of the support during your preparation for exams. Very important in terms of your planning. Your prescribed textbook, your study guide must be two things that you are going to reference on in terms of theory. Application is important through the practice of exercises, exam papers, and any additional questions that you may have. Very important, when you are doing those questions, you must work under exam conditions. So in terms of you writing exams from home, please take advantage of the home advantage. Prepare where you would want to quickly look at information, because 2 hours is a little time to write an exam. So do not have hope that you'll be able to page through other notes. That 2 hours is very little. So you can bring on things such as layout, the structure, but not necessarily that you will unpack many principles in that 2 hours. Master the principles, work under exam conditions when attempting a question. Please do not use the OER methods. Enjoy the practice and allow learning to take place. Always read the required first so that you know what is expected of you. Read the information in the scenario and make notes. Make sure that you use the correct format and disclosures. Show all calculations and reference your calculations appropriately. Ensure that you know the financial year end of the entity, and also where you are tricked in terms of dates, you can be able to get that information. In terms of your exam, I can only wish you all the best for your exam, and hope everything comes true for you. All work that we have done so far is available for you in terms of the recordings. Please do make use of the recordings to understand principles. We have done a lot of questions that should at least ready you for exams. Please note that I'm sharing feedback and evaluation form for you to please fill in for the exam. Any questions with what we have covered today? Right, if there is no questions, then we will adjourn today's class. Thank you very much for attending. I will be available online. Please do fill in the evaluation form, very important. I'll be available online as well in the next 5 minutes for any questions that may be there. Thank you.
I'm struggling to unmute you.
Yes.
Hi, I do have one question. I think that question, it relates to the assignment that we did, the Dilata assignment.
Sure.
Point number one. The one thing that I just could not understand, even when I wrote my assignment, the part where it says Dilata Limited acquired and occupied land on which both the factory and office building were erected on 1 July 2017 at an amount of 1 million. How I took it, and then and also the other part where they say the factory building was constructed on the land on 1 August 2017. How I took it as 1 million, and then I calculated the depreciation of 40,000, accumulated depreciation of 40,000, and then I took the 2.4 million and added the two together. So the 72,000 plus the 40,000. So I'm still confused. Even after we did this, I'm kind of like, how come the 1 million is not featuring anyway?
Remember,
it's now only the 2.4 million.
Remember, this is where information like this is really a big trigger for students. Let's read the question. Delata acquired and occupied the land.
Yeah.
On which both factory and office buildings were erected on 1 July at an amount of 1 million. So this therefore means land was acquired on 1 July 2017 at 1 million. This is what this means. So this is the other phrase that is here means factory and office buildings are erected on the land. This is what it means. You understand?
Okay, I understand now. Thank you, because I was so confused. It just didn't make any sense for me. Thank you.
Yes, all right. This is the problem with accounting, especially for examination purposes. They always put information like this, and then you think the value is actually for factory and office building and not the land. Right, please don't forget to complete the feedback and evaluation form. If you're happy with everything, you can also exit because I see we do not have any more questions.